Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with some quick tips for you on how to compare mortgage insurance. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of Fannie Mae guidelines. Also, this video was created on February 14th, 2017, and the information contained in this video is subject to change without notice. All right, so let's talk about private mortgage insurance. We know that it's required whenever a loan to value exceeds 80%, but there are three types of mortgage insurance options that we're going to discuss. First off is the monthly PMI, which is also known as BPMI, borrower paid mortgage insurance. Then we're going to talk about lender PMI, also known as LPMI, lender paid mortgage insurance. And then finally, single premium financed mortgage insurance. So let's take a look at monthly MI, BPMI. This is the most common type of mortgage insurance that you'll see. This type of mortgage insurance is included in the borrower's monthly mortgage payment. It's risk-based MI factors from 6 to 35%. So what that means is that the higher the LTV goes above 80%, the higher that monthly MI factor would be. So to figure out the monthly MI amount, you would simply take the LTV and figure out what the MI factor is based on the risk sheet from Fannie Mae, and then you would take that and multiply it by the loan amount and then divide it by 12, and that's how you would get the monthly MI amount. Also, monthly MI is available for LTVs up to 97%. And it stays on the loan until either the borrower pays it off, refinances it, or they reach LTV of 80% or lower. Next, let's talk about lender paid MI. And this can be, it just really depends on the market and what the rates are doing. In some cases, lender paid MI may be a better option for the borrower. So here are the characteristics. There's no monthly mortgage insurance, but it has a higher interest rate. So the borrower is still paying mortgage insurance, but instead of paying it as a monthly fee, instead it's included in the interest rate. It is available up to 97% LTV. And here's one of the disadvantages of it, is that it is on the loan until the borrower refinances or they pay it in full. Now, one other thing to keep in mind is when interest rates are higher, a lot of times this can be a lot more attractive because that's more interest that the borrower can write off on their taxes. But really, it just depends on the different factors and rates and where MI is at the time. Now, let's take a look at single premium finance. Now, this is not as common, but in some scenarios, this could be the best option for the borrower. So it's very similar to the upfront mortgage insurance premium for FHA. It's where the borrower will finance the MI, the mortgage insurance, into one lump sum into the mortgage. There's no monthly MI, and typically they're not going to have that increased rate because they're paying it all up front. It is available up to 97% LTV, and it's a one-time payment, so it doesn't continue for the life of loan or anything like that. But the key is when you're working with your borrowers to really compare all three and figure out how long the borrower is going to be in the property and weigh the costs and the benefits of choosing which type of MI is going to be best for that borrower's situation. All right, everyone, that's all for now. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org and watch for our weekly mortgage tips and videos designed for all mortgage professionals, including underwriters, processors, loan officers, closers, and post-closers. Thanks again. Have a great day. We'll see you next time. Bye-bye.